Every week, we post videos that break down important global shifts, the kind of stories that don't make headlines but shape markets. If you care about what actually moves the world, you're in the right place. The Federal Reserve is rethinking its strategy. No headlines, no policy change yet. But this quiet shift could influence every rate cut going forward. At a recent research conference, Chair Jerome Powell confirmed the Fed is launching a review of how it sets monetary policy, including the 2% inflation target. It's the first formal review since 2020. The Federal Reserve operates under a dual mandate: to keep prices stable and to support maximum employment. Its previous strategy, called average inflation targeting, aimed to balance those goals by allowing inflation to run slightly above 2% at times. But after the surge in inflation during 2021 and 2022, that model lost credibility. Now, the Fed appears to be shifting back to a more inflation-focused stance, one that could delay rate cuts and give less weight to short-term employment gains. This isn't the first time a policy review has changed the landscape. In 1979, Paul Volcker broke with past doctrine and aggressively raised rates to crush inflation, ending the stagflation era, but triggering a deep recession. In 2012, the Fed adopted a 2% inflation target, anchoring expectations globally. And in 2020, it shifted to average inflation targeting, a move meant to support job recovery after COVID, but one that misjudged how fast inflation would return. Each shift left a mark on markets, on employment, and on how the world views the dollar. This new review could be just as consequential. Even before any formal decision, markets are already responding. This strategic review affects bond yields, inflation expectations, and how investors price risk. Today, the Fed's decisions are shaped not just by economic data, but also by political pressure and rapid changes in the financial system. Political pressure is building, from rising concern over government deficits to public calls for lower interest rates to ease borrowing costs. At the same time, new forces are reshaping the financial system. Crypto, stablecoins, and real-time payment platforms are challenging how central banks control liquidity and inflation expectations. These outside pressures don't formally shape Fed strategy, but they raise the stakes. And they may explain why the Fed is moving more cautiously and reconsidering how it communicates long-term goals. But even with all this outside pressure, the Fed isn't a one-man show, and that matters. It's easy to focus on Jerome Powell, but the Federal Reserve is a committee. Rate decisions are made by the Federal Open Market Committee, a group of 12 voting members, including Fed governors and regional Fed bank presidents. Each member brings different views shaped by their region, mandate, and economic outlook. They vote, and the majority decides the path of interest rates. Powell leads the conversation, but he doesn't act alone. This collective structure is designed to balance regional and national priorities, especially during periods of uncertainty. There was no official press release. But this could become one of the most important changes to Fed policy since the pandemic era. If rate cuts aren't arriving as expected, this quiet framework shift may be the reason. The Fed is updating its approach slowly and carefully. If you found this video useful, consider liking, commenting, and subscribing. Our goal is simple: to bring you knowledge and insight that matters, with minimal time and maximum value.